Okay, we are just waiting for a few more people to join, and then we can go ahead and get started on our Q&A webinar. I see a lot of people coming through from the waiting room, so we'll just give it another minute or two. Hopefully everyone's having a good Wednesday. We'll give it one more minute and then we can get started. Okay. It is 12:01, so we're going to get going. So good afternoon and welcome to today's webinar. My name is Camille Blomdahl and I'm the Director of Client Services at WealthTrace. I am joined by Doug Carey, who is the founder of WealthTrace and a chartered financial analyst. We will be answering any questions that you have about WealthTrace today. If you want to ask a question, please click on the Q&A button at the bottom of your Zoom window. I will be answering questions live, and Doug will be answering questions by typing them out in the Q&A chat. If you see a question that you find interesting and you want to make sure that we answer it, then you can click on the little thumbs up button next to the question to upvote it. This will bump the question up the list and make it a higher priority. Please try to keep your questions general. We will not be able to make any recommendations or answer any questions about your specific financial plan. This is also our first Q&A webinar, but we hope to do these on a regular basis. So please bear with us if we encounter any technical issues or hiccups. And I'm going to hand it over to Doug to let him introduce himself.
Thanks, Camille. Hey, everybody. Thanks for joining. This is Doug Carey, and I am the founder of WealthTrace, and I've likely talked to some of you before in an expert support session or in live chat. Today, as Camille said, I'm going to mostly be answering some more of the basic questions in the Q&A chat window, and Camille is going to be handling the live questions that don't lend themselves well to just typing into chat. And I'll hand it back to Camille.
Thank you very much. So before we get started, I just wanted to show everyone a screenshot of where the answered questions go to avoid any confusion. So if we do answer a question in the chat and not live, there's a little tab up here in the Q&A window that says answered. So if we answer in the chat itself, it will go there. And if you want to upvote a question, like I mentioned before, this is what the little thumbs up button looks like. So they'll be in the open window and then you can thumbs up it and it'll bump it up the list. So I will go back to sharing my screen. So let's hop over to the software. So I'm seeing a question from Bruce where he's asking how are the performance numbers on the assets calculated? He's asking if it represents returns that are published by the asset manager or by the asset growth in WealthTrace. So all of our performance is based on historical performance. So we look at the last around 40 to 50 years of performance for the asset. And it is based on the asset class itself. So not the actual individual holding, but the asset class that has been assigned to the holding.
I'm wondering also maybe if Bruce is referring to the historical performance we show in the investment history section.
Oh, good question or good point.
But if it is, then that's published information for sure. We get it from a third party, which basically gets the same data, gets some from the same source as Morningstar.
Hmm. Right. If he's referring to this data, then yes. Good point.
Okay.
And then I see a question from Tom, how to consider the COLA versus the inflation rate. So the COLA rate is going to affect your Social Security payments in the plan, and the inflation will affect your expenses and projected um, income or projected investment values, I should say. And then Kevin is asking if we can define which account the RMDs are coming from. And right now, no, we cannot. They will go from any IRAs that you have that require RMDs to be taken out. It will be taken from each account. So the value that you're seeing, let me head over here. The value that you're seeing in the RMD section here is the total from all of those accounts. I see a question from Ed asking what is being varied in the Monte Carlo simulations? Only assumed returns with the assumed standard deviations question mark. Doug, since you're very good with the Monte Carlo, would you mind answering that one?
No problem. It is just the returns that are being varied based on the asset classes, standard deviation and correlation with other assets. I think what a lot of people wonder about is inflation moved around in the Monte Carlo simulations? And we do not do that because my belief was that it creates a lot of confusion as to what's really going on in each scenario. So just the returns are varied.
Thank you. Seeing a great question from Ed regarding what is the best way to understand how the program calculates taxes, specifically capital gains versus income based on the assumed return. So if we head over to the cash flow, there is a great tab called investments by each account. And you can either choose to just do, actually, let me think of this. Do all here. We head over to the,
I think there's an option to show dividends by each account.
okay,
Uh,
let's see. Yeah, I typically default to go to all because I can see everything.
okay.
But let me see. Which is the, which one were you thinking about?
And that must be in the totals then, just the where it shows the dividends, and then the growth due to capital gains. I think that might not be under each account.
Oh, here we go. So,
Oh, there it is. Yeah, due to dividends. Sorry.
yeah, so this is a great way to view that information. So you can see due to dividends, due to price appreciation, oops, due to interest. So if you scroll through these, that should answer your question about how we calculate taxes for capital gains
And then
versus.
if you and then in the expenses taxes area, you can see it rolled up in
Mhm.
terms of the actual taxes paid.
Right. Yep, another great spot to go to look at that. I see a good question from L. John about how does our Monte Carlo simulation different from other software packages? How do you ensure that the simulation gives a good reflection of possible scenarios? So again, Doug, I trust you to answer this one well since you are an expert at Monte Carlo.
Oh, sorry, I was typing an answer to somebody. Which question was this?
How
Oh,
does
how does
our
it
Monte
differ?
Carlo, yeah, how do we differ from other softwares?
Okay. Yes, this is a very good question, and I try to get this across to all users, everybody. There is a big, big difference between WealthTrace's Monte Carlo and others, and that is because not only do we allow linking of accounts, we pull in all of the holdings for every account and map the holdings to asset classes based on information from the broker. We then are able to look at every holding and give each holding a standard deviation and correlation, and also, of course, a historical rate of return. That makes the Monte Carlo and WealthTrace much more accurate, because we are digging down into the details, right? I've said it before, garbage in, garbage out. A lot of free Monte Carlo and non-free Monte Carlo simulations have no idea what you own, and they're guessing, or they force you to enter some kind of standard deviation, and what percentage of the population even knows where to begin with that one, right? They
Mhm.
shouldn't know that. So that's the biggest difference for sure. There's some nuance in terms of number of simulations, maybe. We do also allow two different kinds of distributions. The default is a normal distribution, but you can change that to use a Laplace distribution,
Mhm.
which is basically the likelihood of more extreme events is higher, so it has fatter tails on the distribution. A lot of people do use that these days because of some of the volatility we've seen in stocks and bonds recently too. So I would say that's another difference. Most packages don't have that option to change the type of distribution used. Yeah, Camille's just going to show that right now.
Yeah.
There's normal versus Laplace. And it's sometimes interesting just to flip it to see the difference. Laplace will usually give you a worse result for Monte Carlo because of the extreme events.
See if it changed anything. I'm curious. But we
Yeah,
should see a difference.
it should be lower.
Yeah.
I don't remember what
Change
it was
this.
before, but
I think we're at 95 before, 96
okay.
maybe. Yeah.
Yeah,
So we went
the
down a
more
decent amount.
equities you have, the more it will drop. I should say the
Hmm.
bigger percentage of equities you have, the more that will drop.
Hmm. Thank you. So we have a question from Charlie, and he says when he runs his report, there's no cash to use for expenses, even when he has $1 million in cash. So there's a lot of different things that could be affecting that. The best way to figure out what's happening is to go and look at how expenses are paid. Here you can figure out why that cash isn't being used. It could be that you have other factors that are enough to pay for expenses, like Social Security, RMDs, additional cash inflows. It could be a heap of things. So if you're not sure how the software is assuming that your expenses are being paid for, this is the section that you want to go into. Could also have to do with the order of accounts. If you have your accounts set up to pay out in a different way versus taxable or tax advantaged, that could also affect it. So if we pop over here, you may need to look at these settings as well to see how your accounts are actually being used. And I see a question from Michael whether or not we have a guideline manual that outlines where to enter information. So he's asking about the comment on the webinar where I said to put your more basic expenses for your annual expenses, and then anything outside of that you want to put in your goals and additional expenses. So Michael, if you have anything more specific that you want to ask, I can answer that. But just to touch on what he mentioned, again, regarding the expenses, all your annual normal expenses like bills, electricity, household expenses, your day-to-day expenses you want to input here. And if you have anything outside of that that changes more often, or if you have certain frequencies, you're buying a car every 10 years, you don't want to include that, things like that. But if you have more specifics, um, feel free to pop that question in there. So Michael's asking, what is the best way to update income items each year, like Social Security or pension income? So anytime you have an update to your Social Security or your pension, you can pop that in right here and just update it. Even though it says your age when the payment begins, you still want to put in your payment that you're getting now. Same goes for pensions. If that changes, you should update this annually. Just keep on track of it. The software will obviously future predict changes, but if you are updating your program or the software, then you want to update those numbers anytime that you're kind of in there so that it can project it properly, if that makes sense, or accurately. Marion is asking, once you're taking Social Security, how can one input the actual payment amount? So you want to input your annual payment right here and then indicate when you started taking your Social Security. So you want to input the amount that you're receiving now. Tom, I can see your question about Monte Carlo. He's saying, I know an acceptable Monte Carlo is purely individual opinion, but curious on where you think is a good point to settle. I'm 91%, and my investment advisor says mid to upper 80s is more sufficient for most people. I wouldn't say we typically make a recommendation on that. Doug, do you have any recommendations of where you think people should be when it comes to Monte Carlo, or kind of how to look at it?
It it really is plan specific. Some people are totally fine with, let's say, 90% if they have discretionary spending they can cut back if there's a massive recession or massive bear market. It also depends on, do you have a lot of equity in your home you could tap in case of emergency, right? There are definitely little asterisks next to the Monte Carlo number. So no, I would never give a general number for that. I don't think it's wise to do that, except for saying, if you're if you're 50% or below, something's wrong, and that's trouble no matter what. But once we start talking about 80s versus 90%, I'd have to see the plan, and that's what I will look at that in expert support sessions for sure. But yeah, I'd have to see the actual plan itself.
Mm-hmm. Christopher asked a question about zero legacy or spend to zero function. You marked that as answering live. Do you know exactly what he means with that, Doug?
Um, what you can do, I assume you mean leave nothing for heirs. You can do that. We have a solver
Oh.
in scenarios where you can say you want the investment value at the end of the plan to be zero. How much can I spend to get there? Or you can just mess around with the sliders, which is really just as easy because they're so simple to use. So yeah, if Camille's going to show that now, where all you have to do is keep playing with the living expense number. So increase that, Camille, and then see when the end of plan goes to zero. Just do the living expense up top.
This one.
Yes. So increase that to max. Let's see if it gets you to zero. Oh, it did. So there's a shortfall. You're at zero. And then you can just keep dialing it down a little bit until you finally find, oh, okay. If I spend 50,000 more per year or whatever it is, I'll have $100 left or $10,000 left, right? Basically zero.
Mm-hmm.
So I do that with Monte Carlo a lot more than I do the zero amount left because the home screen is a static look at things. It assumes rates of return are the same every year on your investments, whereas Monte Carlo, of course, is changing them in every year. And it's a more it's a better look at what are the odds of you ever running out of money. So um, that's the way to do it. But if it were me, I'd be more looking at Monte Carlo and saying, okay, how much can I spend such that my probability of never running out of money is X percent, whatever that percent is that I'm comfortable with. Let's say it's 85. So, okay, here's how much I can spend and not go below 85%.
Mm-hmm. Thank you.
No problem.
So we have Ed asking, what is the best way to include inherited assets, i.e. taxable accounts with a stepped up basis, IRA and or Roth IRA? So we do have the option to add an inherited IRA in this section. Oops, let's say, oh, use an existing one. So you do have the option to add an inherited IRA here and specify whether it is non-spousal or spousal. Oh, sorry. Actually, no, it's only non-spousal. Sorry. But you can add the inherited IRA or the inherited Roth IRA in this section. So Michael, I can see that you're asking if we can demonstrate a Roth conversion analysis to determine whether it is beneficial. So the plan that I have that I'm using here is not set up for a Roth IRA conversion to work at the moment. We will, however, be putting together financial planning courses in the future where we will discuss things like Roth IRA conversions and whether or not they do make sense. We also plan on hosting a Roth IRA conversion webinar at some point where we will have a plan that is set up for that. So if you would like to attend that, just keep an eye out for the email when we
Can you
announce
show
the
them
link.
just where it is
Yep.
though, the
Oh,
scenario?
yeah,
And I'll give a quick blurb about it.
sure.
We do have a lot of questions about Roth conversions. It's become very popular. So in the Roth conversion scenario section here, what most people do is they try to stay under a certain tax bracket and they dial in um, until they find the maximum amount at the end of their plan. And of course, you want it to be more than the baseline, which is do nothing. Now, I won't go into detail on the best way to achieve it. I do this in expert support sessions, but
Mm-hmm.
also there will be a lot of new features for Roth conversions too, in terms of being able to stack scenarios, which somebody asked about that already, things like that.
Mm-hmm.
But yeah, it's quite powerful, and I do recommend that everyone check it out and take a look at to see if it even possibly makes sense for them to do a conversion, especially if you think tax rates are going to go up in 2 years, which that is a segue into a question I just saw, which does the program assume the sunsetting of current tax rates in 2026? It does not
Mm-hmm.
assume that because I doubt they will raise taxes on everybody, but maybe the upper bracket or two. Uh, so you will have to manually turn that on, which there's a setting that Camille's showing right now.
Mm-hmm.
So yep, that's the setting if you want to assume your tax rates will indeed go back up to those levels.
And we have a question from Mark if there's a way to add a specific list of mutual funds as a portfolio to compare my current plan to.
Uh
What would be the best way to achieve that?
yes, you can add them manually, hold manual holdings, right?
Mm-hmm.
So if you just want to show them real quickly how to add manual tickers, so you'd create another investment, and then temporarily, I guess, turn off your current portfolio, set it to zero or something. And then yeah, so you can add your own tickers here, and we'll retrieve the prices every day. well, actually each time you log in for that ticker, and then you can do comparisons. You can either upgrade to the multiple plans feature, which is $99 a year, where you can create up to 10 different plans, or you can just keep setting a portfolio that you're thinking about replacing, set its balance to zero, and run the comparison that way.
Mm-hmm. Thank you. Yeah, that would be a great way to do it. And then Mark is also asking if we are considering adding two-factor authentication in the future. And I believe that is on our agenda for our next user interface release. Am I correct in saying that?
Yes, it is coming along with a total revamp of our UI. The new user interface will be easier to navigate for sure. It will be much, much faster. We will have two-factor authentication along with a lot of other interesting things. The ETA is, probably 7 months.
Thank you. And then we have Herman asking if there's a feature to remove expenses after a certain amount of years. So yes, anything that you want to have end after a certain amount of time. So anything out of your ordinary annual expenses, like we mentioned before, you can pop in here and you can specify the start age and then the end and how often it will occur. So whether or not it's occurring every single year. I can open this up for you guys. So here you can specify when you want it to start. You can also tell the software if it will be funded by a single investment first. So if you have a specific account that you know is paying for this expense, you can say yes here and tell the software which account. And then you can go ahead and specify how long the expense is lasting and how often it will occur. Right now I have it set to 1 year, otherwise you would see more options there. Just taking a peek at the questions right now. Just bear with me. Seeing a question from David asking, how do you show that the returns are dividends? So I'm assuming he is referring to the asset class and the returns. So am I correct in answering that this is that section that he'd want to look at, Doug? I'm assuming that's what he's referring to.
Yes, this is the best way to tell the program the percent of the return that will come from dividends.
Mm-hmm. And you
And
can also obviously make any changes here.
yeah, you can edit and save and even create your own asset classes here if you wanted to create something that's, let's say, 100% dividends that doesn't match these existing asset classes. So if you have a dividend fund that's, well, 100 is probably ridiculous, but let's just say it's much higher than typical. You
Mm-hmm.
might want to create an asset class here called dividend portfolio or something like that.
Mm-hmm. Thank you. So Greg is asking or telling more like it that WealthTrace is showing over $1 million left at the end of his life, but Monte Carlo is showing 75% probability of funding all goals. He's saying that it seems like the probability would be higher with that much money left at the end of his life. And why is this? So Doug already mentioned a little bit about the fact that this screen will show you static returns. So the software will assume that the rate of return is the same every single year, which is why you may see a higher value here than what you will see on the Monte Carlo, especially if you have a more aggressive portfolio. So if you have more volatile stocks and bonds, this number can be a lot lower because the Monte Carlo runs the simulations with varying returns every single year. Whereas the home screen is just a static look with the same returns every single year. Do you want to add anything to that, Doug?
I don't think so. That's pretty much what I would have said. Nice job.
Okay.
I do want to go into this long-term care question.
Okay.
Camille, if you go to the scenarios,
Oh, yeah.
we do have some long-term care scenarios where you can see if it makes sense, yeah, under insurance to get long-term care insurance, but I'm not sure if that's exactly what you're asking. What a lot of people do is they add an expense for long-term care in the goals and additional expenses section, where it's kind of a worst case scenario where they'll say, all right, I'll be in long-term care for 4 years at 100,000 a year. What does that do to my plan? Do I have enough? And if I don't have enough, okay, I'll run another scenario where maybe I take equity out of my home or sell my home. So you can keep just playing around with it that way. That's what most people do for long-term care. And then as I mentioned, there's a section for long-term care insurance where you can just see if the insurance makes sense given the cost of the premiums.
So if they want to add that actual long-term care into the plan, this is the section that they want to do it.
That's what I would do. I would put in an expense here as a kind of an emergency expense and see if how the plan holds up.
Mm-hmm. Thank you. So John is asking, what is the best way to enter real estate holdings, primary home, vacation home, and rentals? Considerations for capital gains and rental income. So you can add if if you want to add your primary home in this section, vacation home in this section as well. As for the rental, I would say it depends. Some people do enter it in here to have it added to their net worth, and then they add the rental income in the additional cash inflow section. You can also specify the tax rate here, which is helpful for the rental income. As for real estate holdings, if you're talking about an actual investment, then you could add it as an investment asset and assign an asset class that you create on your own called real estate if you want it as an asset. So there's a couple different ways to do it. One is not necessarily wrong, neither is the other, but it just depends how you want it to show up in the plan.
And if you know you're going to sell something,
Mm-hmm.
you do want to put it in the cash inflow section.
Right.
And you can see under the effective tax rate, you do have the option to use the income tax rate, the capital gains tax rate, or enter
Mm-hmm.
your own. Uh, I would definitely use the capital gains tax rate if that's a typical property that will be taxed at capital gains. You just
Mm-hmm.
have to make sure you separate out the cost basis, which will not be taxable, and the gain, which will be.
Right. Thank you. Just going through a couple of these questions. So Christopher's asking, how do you force withdrawing funds in a particular order between taxable / tax advantage, tax deferred, and non-qualified? The advanced setting allows in order or pro rata only within an account type. So there is a certain order of withdrawals. Let me pull that up quickly in the background, but you can drag and drop accounts to a certain order, which will force, but there is a hierarchy which will be followed. So let me pull up that article. I think a lot of people miss the fact that it goes in this certain type of order. So there's only so much you can force. So this is the order of withdrawals that will occur in the plan, but you can still drag and drop within these, or you can lock accounts out to later. That is another great way to do it. So in this section, if you have it going in order, it will take first from the savings accounts, then the cash account. But if you want to change the order, you can drag and drop these. And if you want to force it to use an account, you can lock the other accounts out. So you can say use this account after all other accounts are gone, or you can allow funds to be used at a certain date. So if you really want to use one of these other accounts, you can stagger them and lock them out to different dates, or drag and drop them, or lock them out till the end. So there's a couple different ways that you can do it. But just know that it will pull from this order unless you kind of play around with it. Joe is asking, is there a place where I can see which assets are being utilized to pay for expenses, goals, taxes? So we looked at this a few minutes ago. Let me pop over to the screen again. This is a very helpful screen to look at. So if you go to the cash flow projections, expenses, and then how expenses are paid, you can see exactly what assumptions are being made. If you want to get even more into the nitty-gritty, you can also look at investments by each account, and then you can see here expenses and taxes paid from growth, balance, etc. And you can go through these and it'll show you exactly which account it's pulling from and whether or not it's taking it from the growth or the balance. So these are two really good sections to go take a look at. Mark is asking, what is growth in taxable and tax advantage investments due to interest? Is interest capital gain distributions? Can you touch on that, Doug? I'm not sure I 100% understand what he means.
Uh, well, the first part I understand, it's the growth
Mhm.
in taxable tax advantage due to interest is the portion of that return that's due to interest. So for example, if you have an investment account that has a fund that's all sorry, has one fund that's 50% of the account and that's all equities, and then another fund that's 50% of the account that's all bonds, then of course a portion of the overall return will be due to interest. So we show that for planning purposes. And we also show the portion of the return that's due to dividends versus capital gains. And we did show earlier where that's all determined, and that's in the asset class assumption section that you can edit. You can edit for each asset class the percent that's due to interest versus capital gains versus dividends. That way we can get the taxes right. So I would recommend that everyone look at the asset class assumption section, see if you like the returns that are in there in terms of, are they conservative enough for you, or maybe you think they should be higher. But a lot of people actually dial them down just to be more conservative. And then, of course, you can change the percent due to interest, dividends, or capital gains in there.
Mhm. So Tom is asking, can you customize/change the tax rate assumption in any future year? So let's pop over to the taxes section. Any tax changes that you want to make, you can make here. So you can either choose to use the program estimate, or you can input your own income tax rates here. And also down below, you can change your state tax rate. So if you're moving to another state in the future, you can indicate when, if it's at retirement or if it's at a certain year, and then what that rate will change to. So your current rate and your future rate. So Christopher is asking if there is a way to force the model to start at the beginning of the current year, so it doesn't throw off the end of year values for the first year. And no, I don't believe there's a way to force that. Am I correct in that, Doug?
Well, yes, sort of. It depends what one is looking for. What we do is we try to interpret a full year for income purposes, tax purposes, right? So
Mm-hmm.
we're approximately 6 months into the year, and let's say your projected dividends for the remainder of this year is $10,000. We will double that in order to get a good estimate for what your dividend tax rate should be. Same thing for pensions and social securities, things like that, where it's pretty obvious that they were a full year's payment. So in that sense, we do use the full year, but you cannot set the date back or anything like that, or
Mm-hmm.
run from January 1st of this year.
Right. So David is asking, I have not used asset classes before. If I create dividends, will the taxes on them be accurate? So I'm assuming he's touching on the return due to dividends, and yes, the taxes will be accurate. If there's more to that question, feel free to ask again. But yes, the software will understand um, the dividends part of it and calculate that properly. Joe is asking, is there a place in the model to see the cost basis in my taxable account? And yes, there is. So for any linked accounts or any accounts, you can, so for linked accounts, I should say the cost basis should come over automatically. If it doesn't, you can change it. And if you are entering a manual account, you can edit the cost basis. So click on here, and then you'll see the account cost basis right here, and you can change that. Kevin is asking, how is the portfolio withdrawal rate calculated? I'm not sure exactly.
I think he's talking about cash flow distribution. So go to cash flow projections.
Okay, so just how the expenses are paid?
No, so I don't think so.
No.
Scroll down when this loads. So scroll until the bottomish. Portfolio withdrawal rate right there, about
Ah,
the middle. Yes. So basically, it's just adding up your income versus your expenses for that year, and if income's not enough to cover expenses, then you have to take money out of your portfolio. So if you have to withdraw principal, it will be negative. And if you're adding the principal because your income was more than enough, then it will be a positive number.
mm-hmm. Thank you. Tom is asking if we tax dividends and capital gains based on each year's AGI/MAGI. Do we do that?
Yes, we take great pains to calculate the adjusted gross income and
Mm-hmm.
modified to get the accurate dividend and capital gains tax rates based on updated brackets every year. And if you go to expenses taxes there, Camille,
Mm-hmm.
you'll see not only the capital gains and dividend tax rates, but the net investment income tax rate as well. So you can see that this particular plan does get hit with the net investment income tax rate a few years down the road. So yes, it's pretty accurate.
And the software needs 2 years of data to calculate this, correct?
Yeah, we look back 2 years, and if we
Mhm.
don't have 2 years, then we do the best we can by using the most recent year.
Mhm. So Herman is asking if we have time, if we can walk through the Roth conversion demo again. I'd like to better understand the configuration choices and how that impacts the results. So, like we mentioned a little bit before, the Roth conversion is a little bit more complicated than just showing it. This plan is not really set up for a Roth conversion scenario to work at the moment, but we will be doing a Roth conversion webinar at some point in the future. And we will also be releasing tutorials on how to use the Roth conversion scenario, or I should say, financial planning courses on how to use it. But right now, we can't really show much more than just how to input it, but whether or not it will work for you is a little bit more complicated than that.
There's a question about annuities we should answer.
Yeah. Should annuities get linked to the investment value / net worth slider via the linking application and then added to the non-qualified / tax deferred tab? Not sure what he's referring to with the investment value / net worth slider.
Not exactly sure, but I will answer this the best I can.
Okay.
Uh, so most annuities, if you link accounts, will come through as investments and they will be placed in the non-qualified tax deferred section. Now, every annuity is different. We have no idea what the annuity will pay out in terms of any income. So what a lot of people do is they put the guaranteed, if there's guaranteed income, into the additional cash inflow section for that annuity.
Mhm.
And if that's the full payout, then they set the annual return for that annuity to 0%. So that way they're not double counting any type of growth in it. So that's typical. But like I said, every annuity is different, and you'd have to understand the rules of each one.
Mhm. Right. Then Joe is asking if there's a place where he can see which assets are being utilized to pay for expenses, goals, taxes. So we'll go back to one of my favorite tabs over on the cash flow projection screen. So yes, if you head over to expenses, how expenses are paid, you can view that here. If you want to see exactly which account, not just which section, you can go to investments and cash inflows, investments by each account, and then you can see expenses and taxes paid from taxable and tax advantage growth and balance. And if you look at these, you can also see exactly which account is used. If you click on, sorry, if you click on all, you can easily look at every single one of them and see what assumptions are being made. So if we keep going, so expenses paid from here, for example, you can see that these are being used. So it's using the iBonds account, this account. So this is where you want to go to see all of that information. I think we've answered all questions.
Yes, looks like it.
Great. Well, let's see if we have any more come in. So unless we have any more questions that pop up, hold on. I see the 529 plan being used. Was there a goal? Yes. So in this plan, there is a 529 plan in here as an asset, and then I also have an additional expense in here called Allie's college tuition. If we take a peek at this, you can see that this is being specifically funded by her 529 plan. So that's pretty much it, unless anyone else has any questions. Okay, more questions are coming in. If you put a loan in the liabilities section, does it automatically show the payment of interest, or do I need to enter that elsewhere? So you will want to enter your entire loan, and it will calculate the mortgage for you. So you don't want to enter any additional interest anywhere else. So if you input your mortgage here and your loan information here, it will automatically calculate your annual mortgage cost for you. David is asking if there is a tutorial, and yes, there is. Let me pull up the website for that quickly. Hold on one moment. Doug, is there a way for them to get to this tutorial without us sharing the link?
Um, we have to share the link, but anybody can use it.
Why don't we add, let's see, I'm gonna go ahead and comment. Oh, that's way at the bottom. Let me see here. I added the link to David's question, but that might be way at the bottom for everyone. We can include.
Oh, sorry, it's in the if you go to the help, if you log in and click your username and go to help, there's a link there.
Oh,
It says
perfect.
watch the tutorial.
Okay, great. So if anyone wants to take a look at the tutorial, there's a ton of information in here. Just go ahead and go to your plan, click on help right here, and that will take you to this page where you can click on watch the tutorial. And you can also see the link to our knowledge base right here and our user manual. Okay, so now I'm assuming we don't have any more questions. I also wanted to mention all of our various options for customer support. So as many of you have probably noticed, we have a live chat down here. So if you have any questions on your plan or in general, you can just chat with us here. And if we are not online, you can leave us a message and we will get back to you as soon as we can. We also have an extensive knowledge base right here where you can find answers to your most frequently asked questions. You can type any questions that you have in the search bar, and any related articles to that question will pop up. And like I mentioned a little bit before, we will also be putting together financial planning courses for active subscribers soon. So, for example, we will discuss things like how to determine the best order of withdrawals, Roth IRA conversions, what are they, how do they make sense? We already talked a little bit about that, how to interpret your Monte Carlo results, and much more. And finally, we also offer expert support sessions with Doug, who is in the Q&A right now. And he can audit your plan for you and review all of your plan inputs with you. So unless we have anything else, so David's asking a little bit about what are the next features to expect. Do you want to talk about that, Doug?
Oh, sure. Next week, we're hoping to have a release where the main feature is the ability to put in your state or the state you plan on moving to, and we will calculate your tax rates for you based on that state's particular tax laws. So that that's a pretty big change and will be nice for not just accuracy, but Roth conversions, where if you're moving, then we will accurately calculate your new tax rates, even if it has a progressive income tax system.
Mm-hmm. And then Peggy was asking again where we access the support area. So if you just click on your username at the top right and then click on help, that will take you over to this page. where you can also email us questions if you'd like, or head over to the knowledge base, tutorial, user manual. And I think that's it. Unless you have anything else, Doug, I think we're all done.
And yes, we will be emailing out the recording of this as well in case you want to go back.
Yes.
So thanks everyone for attending. This has been great. Good questions.
Yeah,
Wish we would
great
have
question.
started this earlier, but we're going to keep doing these webinars for sure.
Yeah. Well, thank you, Doug, for doing this with me, and thank you to everyone that attended.
Yeah.
I hope you all have a great rest of your day.
Yes, take care.
Bye.